Welcome back guys to another Zero DTE video, and today Coach Ernie is going to be talking about safeguarding your trade, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Coach's education platform. Enjoy guys.
So I'm going to create a butterfly and I'm going to make it so I can close any one of them. So watch what happens when I remove one of the long legs by making it go to zero. So by removing the near leg over here, it creates unlimited risk. You see that? Just by removing that. I'm sorry, that's the far leg. Let's say I move the near leg, which is 56.20. Watch what happens then. Similar thing happens. I create unlimited risk.
What about you remove the middle one, the center strike?
If I remove the middle one, which is at 56.40. This is what would happen if I just remove the middle ones. Watch. Then it becomes like a long call because I have two long calls on now. So removing either of the protective ones, the outer legs, creates unlimited risk, but removing the middle strikes creates essentially a long call.
When you remove one of the middle ones, you create a back ratio spread, do you not?
Yes, you still create a long call, but it's not really a ratio spread, but it looks like that. And the only reason you would remove the middle ones is if they reach their max potential.
But if you wanted to make an adjustment towards the end of the day, like you're trying to pin and you want to slide one of the middle ones over and create a condor to increase your chances.
You're getting way too complex. I'm not sure exactly what you're getting at, but let's say that you have the opposite trade. The only time you get rid of the middle one is if price moves way away from your fly and you've maximized the potential of those two short strikes, which would be way out here somewhere. Because now those two strikes have gone into full profit, you can take them off. And then you would be left with what we just saw there, and that would be this. Sometimes we do that.
Yeah, I was thinking about, let's say we can see sometimes the price move very fast and then it's moving in our favor, right? So by that
if
time,
it's moving in your favor, there's absolutely nothing to do. You should do nothing. You should allow it to move in your favor. Now, if you're trying to protect it from passing through your fly, there are ways to do that, but it's a real edge case. Passing through your fly is probably a 0.05% probability, right? But it happens. And so what can you do? The only thing you can really do is you could hedge it with a gamma hedge. That would be one way. What that really means is by putting on a weaker long call so that if it passes through there, it will flatten out your profit curve. And I'll show you what that looks like. So let's say that price is going your direction, but it keeps on going. It wants to go this way. You're right here and you want to protect that profit, but you think price is going to keep on going up. So the only thing that you can do is you want to change this curve so that it's more flat. You want to change the magenta line so that it's not pointing down so that you don't lose that profit. So what you can do, you want to change this magenta line so that it doesn't go down that far. Maybe instead it maybe goes out like this, or even better yet, goes up like that. The way you would do that is you would add like a long call strategy. So you add it to this. Now, there are a number of ways you could do it, but the problem with that is that a long call would be too strong. You'd have to put it way out of the money in order to affect it. What you could do is you could use like something smaller, like a long call for an MES. See, right now I have the ES on, but let's see what would happen if I put on an MES. Well, I'll show you what would happen if I put on a long call first. Let's add a long call right at the center strike at 56.40. So you could do that, and then it would provide you with something like that, right? But that might be too strong because now you have significant risk to the downside. So yeah, it could keep on going that way. So if you felt that, you could put a long call. But there are other ways that you could do it. One way is you could push it further out of the money. So it's not quite as strong, but it changes the shape of the curve. See that? So if you felt like price was going to continue to go up, then as it's going up, it's being hedged. That's called a gamma hedge by doing this, because you've changed the slope of this line.
It does matter what time of the day you put the out of the money call in. If you're in the afternoon, that thing's going to lose value like a melting ice cube.
Yeah, it will.
And then you'll have to put like another one if you're trying to neutralize the delta. You got to keep.
But you're looking at a fast move. So you're trying to take advantage of a fast move. Another way you could do it is you could use stock, which won't lose value. So you could take SPY, for instance, and add long positions to it.
So that's called a synthetic, right?
No, it's not a synthetic. It would be strictly a gamma hedge. A synthetic is where you're using two options to synthesize the behavior of a stock. Just adding SPY shares to this would also change the shape of that curve, maybe a little bit like if you added like 10 shares, it might look like this. If you added 100 shares, then it would look like that. So you could do that as well. You could add long shares of SPY. That would effectively change the curve, but you'd have to manage it. And if it goes against you, you've increased your risk to this side. I think the most effective would be the out of the money long call, this guy, like this. And it wouldn't cost you very much. You could push it even further out. And it's not adding a whole lot of risk to this side. It adds some risk, right? Because the risk here is $200. If I add this, that increases to just $207. Now, you could also predict if it went into your fly from it reversing. Let's say it went into here and you want to protect it from reversing going this way. You just do the opposite. You could put on a long put, make this a put, and then place it below the market. 5,600 or maybe lower like that. So if you achieve some level of profit here and you wanted to keep that, you would put the long put on in case it reverses on you, and then it would look like that. It would keep it flat and you would be making money off of that. And if it doesn't go down, then this will continue to grow in your fly, but you're giving up something. You're giving up what it cost you for the put, for that protection. Insurance always costs you.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.